Hi, everyone. Welcome to Trader Chats, unique perspectives from seasoned traders. I'm your host, Imran Lakha, founder of Options Insight and 20-year professional options trader. As you might know, I became a trading mentor about 3 years ago, but I thought these conversations would be a great way for my students to gain valuable perspectives from some of the professional traders that I know and respect. I hope you enjoy the episode. Welcome back to Trader Chats, everyone. Today's episode is called The Importance of Positioning. And my guest today is my good friend, Brent Kochuba of Spotgamma. Hey, Brent, how's it going?
Great, Imran. How are you doing?
Good. Thanks so much for coming on, mate. It's great to have you.
Absolutely. I love the opportunity.
And why don't you tell the audience a little bit about your background in trading and what you're up to over there at Spotgamma?
Sure. So originally I started off as a broker. I was a broker for Bank of America and Credit Suisse in equities and derivatives. And then I worked for the market maker known as Wolverine. I was a broker there as well. And then following that, I traded for a family office and built some option strategies. And the foundation of those strategies turned into Spotgamma.com, where I write a daily analysis on the options positioning in the S&P 500. And then we also analyze over 3,500 different individual single stocks.
And I know all about Spotgamma because I'm a subscriber myself. So I love the
right.
I love the work you're doing over there.
Thank you very much.
Yeah. So I guess the sort of obvious first question would be, why is positioning so important, do you think? And I'm not talking about necessarily options positioning, but just in general in trading. What is it about positioning that makes it so kind of relevant to market moves and things like that, in your opinion?
Yeah, so I think when you know how somebody is positioned and how large their position is, that is information that is invaluable. And there are a lot of people that strictly trade off of how people are positioned in the market, irrespective of what the fundamentals may be in any kind of asset, right? And you can look at real estate markets or Bitcoin. I know you're a big fan of that, and certainly the meme mania proved this, right? It didn't matter what the fundamentals are necessarily; it just mattered what the supply and demand was, and then you can figure out how people are positioned. Then you know how they're going to have to act or react for a given change in price, right? So it's the behavioral side of knowing how someone's positioned, and then knowing the actions or steps they will take if their position starts to move in their favor or against them.
So I guess trading's all about the marginal buyer or seller, right? That's going to determine whether we go up or down. So what we're saying is, if we can get a handle on a decent universe of the investors who are playing in a certain stock or a certain asset, and we understand what their positioning is, we can get a sense of what their psychology will be. Because at the end of the day, a lot of your actions within the market are a function of your emotions, right? And sometimes those emotions are triggered by moves in the market. And if everyone's basically on the same side of the boat and some piece of news that comes out to the contrary, you know that everyone's going to panic at the same time. And understanding that concentrated position that is out there gives you a sense of where the fragility lies in the market and where you might get outsized positions that are a bit bigger than normal, basically, right?
Yeah, 100%. And I think that applies not only to traders, but when you look into commodities. I mean, today we have the Bitcoin ETF, which is a futures-based ETF. So I'm curious on your feedback there. But look at the oil squeeze. The uranium squeeze is a popular one here recently, where there's a certain amount of uranium that's needed to run generators and the like, and there's an ETF now that's starting to buy up all the physical uranium. So you can start to look around and say, okay, I know where the pressure is coming. I know how the ETF is positioned, right? I know that nuclear plants need to buy uranium, or oil companies need to buy or produce oil. There's not enough oil, and that's going to squeeze these things, right? It's going to squeeze these stocks. And so, you could look at oil that way, or Bitcoin, with the new ETF, is that going to create a scarcity in Bitcoin? And those are positions, right? And those are positions that can be squeezed. And in this case, you can possibly position yourself to take advantage of that squeeze.
Yeah, I mean, I agree. Like, so much of trading is about the psychology of the investor base, right? It's a lot of the time, especially in the short term, right? You get research analysts who study the fundamentals, and they might formulate a really accurate 1 to 2 year view on an asset, and their analysis really does matter to that, and that may well play out over the next 2 years. But what's going to happen in the next half an hour is about positioning. Right. Way more about positioning than it is about fundamentals, I guess.
Yeah. And I think too, I mean, you can even scan back a little bit. I mean, take GameStop, for example. The stock doesn't have any fundamental basis for trading at $190 a share and however many $1 billion of market cap is at the moment. Right. And I think a lot of fundamental people are pulling their hair out saying this doesn't make sense, but there's humongous options positions in that name that just hold this up. And there's a lot of people who have bought the stock and they never want to sell it ever for, whatever their narrative is. Right. And so, this kind of, I guess, circles back to the idea that, price is, what the next guy's willing to sell or buy at. And if you know how that person is going to be forced to buy or sell, then that's the positioning, I think, aspect of it.
Okay, so then that kind of leads on to the next thing, which is, okay, so we understand positioning plays a major part in short-term price movements. Now, how do options positions feed into this, right? And how do they impact the market?
Yes. Yeah, sorry, I didn't mean to interrupt you there.
No.
The fun thing with options in positioning is that we know that most of the people, when you buy or sell an option, you're transacting with a market maker. Or a dealer, and we can estimate based on publicly available data and some of our modeling, where the dealers are positioned or where big pockets of options exist. We know when options are going to expire. We know how hedge activity or hedge flow will have to change based on the stock price movement. So we understand exactly what how these market makers or dealers are positioned. We know when their position is set to change, et cetera. And so we can start to forecast how these hedging flows or the steps that dealers have to take to protect themselves will start to impact the stock or move a stock around.
So it's all about the delta hedging flows, which is what the market makers have to do when they take option positions against, say, a bunch of retail traders. They have to then transact stock against that option position to hedge themselves. And we're talking about those hedging flows that are then driving the price of the stock up or down, basically. Is that right?
Right. That's exactly right. And sometimes it's, quite obvious how people are positioned. I mean, that's what made the meme stocks so much fun to trade. And they've been percolating again recently here with the likes of SoFi and some of these other, names. But we knew that retail was coming in to buy these options. So that made it even more obvious exactly how market makers, were positioned and what would have to happen if the stock continued to go up. And you could see also in the price of options, they are a function of supply and demand, right? When there's more demand for call options, the implied volatility of those options goes higher, the price of the option goes higher. So we can really lock in exactly how people are positioned and what hedging flows may take place for a given step. One of the interesting things about options, obviously, is the timed expiration, right? So there's a decay to these positions. We can bet on what happens to a dealer's position or a market maker's position because of that decay, or what happens if the stock goes down or up, or if people switch from a long view to a short view. So there's so many different ways to play this positioning, based on either your fundamental outlook or simply just wanting to be a trader and, famously not caring what the underlying stock does.
Yeah, so it makes sense. So option positions, the delta hedging of options positions has an impact on the spot price, and the bigger the options open interest is relative to, how much stock trades on a day, on an average day, that's going to have more and more impact, I imagine, right? So, what about, do you kind of keep an eye on the structural hedging flows that are in a market? For example, like the S&P is something you obviously monitor very closely, and we know typically institutions, the big money managers, tend to be buyers of put options and sellers of call options.
Right.
So does that structural flow and positioning that the dealers take the other side of, does that have a strong impact in the dynamics and kind of what you see going on there?
Yeah, that structural position has a very important impact on the flow or the movement of the S&P in the short term. Now, obviously, if the Fed comes out and cuts interest rates suddenly, or some other major macro event happens, the options market could be overrun in the short term, or it could exacerbate the sort of the main movement of the market. But we found and statistically shown that the position of calls and puts in the market and how big that position is has a major impact on the volatility of the S&P 500 and also its movement. I like to give this famous example of sort of how positioning can affect the S&P 500. If you remember back in the COVID crash in March of 2020, the market was down 30-40%, and things were just careening lower, right? And the low in the market, we've talked about this before, the low in the S&P was the day after the March quarterly options expiration. So on the March expiration, which is a Friday, we had hundreds of thousands of put positions expire. So that meant that dealers and market makers were no longer short put options, right? And they could unwind their hedging, meaning they had short hedges to hedge themselves. And the day after expiration, they could start to buy back all of those hedges because they no longer had these put positions on, right? So that put the low in the market. The day after that expiration was the low in the S&P 500, and the market is up, I don't know how many hundreds of percent, something like that since that day, right? I mean, there was just a V bottom off of that. And that exemplifies exactly how positioning can affect a trade and investment, but also how the options position can affect the movement of the S&P 500.
And then you also have these other, apart from just the gamma hedging flows, which everyone talks about, obviously that's in the name of your firm, Spotgamma. You've got these other factors, right, called charm and vanna that most people don't understand, right? But basically, I mean, the way I would characterize that is when you've got this big structural position in puts versus calls, that means that through the passage of time, the amount of hedging that, or the size of the delta hedge that dealers need to have on is a moving target, basically, right? And so as the premium burns away of those options, because that structurally the street is long one side of the boat and short the other side of the boat, as the premium's burning off, they're going to be net forced to buy back futures or sell futures, whichever way around it is. And those are called charm and vanna flows, basically. Is that right?
Yeah, that's exactly right. So if you think about a weekly option, which are so popular in the meme stocks, if I was to buy a call today that expires in 5 days, that call, all else being equal, as in if the stock doesn't move, as that call price is going to decay every day a little bit, right? It's going to drop 10, 20% every single day, just as a function of time. And so if I'm a market maker hedging out that call, every time that call loses value because of this decay function, I can adjust my hedge there, right? So that's the charm flow. And then the second one, as you mentioned, was vanna, which is a big one. And vanna tells us what the delta hedge is for a given change in implied volatility. So implied volatility is a really important function in the options market, but you can think of it as an expression of supply and demand. And for example, when the market is crashing and put values are rapidly expanding, right, because implied volatility is spiking higher, put values are going higher, and a market maker who's short an option is going to be feeling some pain, right? And so they need to hedge by selling more futures. That's the vanna function. As vol expands, they would need to, in this case, short more futures. And as implied volatility comes back in because people think the crisis is over, they can buy futures back. And so when you assume that the position is massive in terms of billions of put positions in the S&P 500 alone, you can see how those flows would have a major impact on the movement of the underlying asset. And the other thing is about this is that it's a reflexive feedback loop. For example, last week there was the market was down around 4,300 in the S&P 500, and there was a lot of put positions. And what happened was after the FOMC came out, there was Fed minutes and a few other macro data points that seemed to give a all clear to the market, right? And the market started to catch a little bit of a bid. So once the market catches a bid, put values start to crash, right? Put values start to drop down, so dealers can start to buy back some of their short hedges. And when they start to buy back short hedges, the put values obviously start to lose more money, right? Because now the market's going up because dealers are buying back shorts. And so the dealers go, oh, now my puts, because I've been buying back stock, now my puts are losing even more value, and it becomes this feedback loop. It becomes this, mechanism to force, stocks higher. So, you know, the reflexive, the word reflexivity is a George Soros term back from the Bank of England when he had built a huge position in British pounds, right? And he knew how the bank was positioned and what the bank was going to do. That's a fascinating story to read. But he knew how the bank was positioned, and he was going to squeeze them. It was positioning and some poker, you know.
Game theory, right?
Yeah, game theory, right? Exactly. That's the word I was looking for. Thank you. So,
yeah, and like, and you know, sort of related to your point as well, the whole vol selling thing, right? Like you're talking about people having to buy back futures, and that makes puts drop even more, and it becomes reflexive. But then on top of that, add the general volatility selling appetite that comes when the market stabilizes, and people might sell VIX futures, or they might sell vanilla options, delta hedged, and they just supply the street with a load of volatility, which makes vol drop even more, which makes the Vanna effect make them buy the market even more, and that just adding to that reflexivity loop that you've described. Right?
Yeah, and you can. What's interesting too is that the S&P 500 now the QQQ Nasdaq ETF, they both have expirations 3 times a week, and the volatility sellers are tend to show up in those products a little bit more. I think because they feel like they have more certainty because it's such short-term days to expiration, and obviously there's a little bit of a premium in there because there's of those extra expirations, and so there's so much flow that comes in those very short-term options to sell that volatility. And then obviously the weekly options in the meme stocks is prevalent. That's where most of the volume is. So you can see these demand cycles, you know, play out every single week, you know, almost every other day now with these extra expirations.
Yeah, so I was going to ask you a little bit more about that explosion in the retail options activity and this whole meme stock craze, and with GME and AMC and all that stuff, and what your take is and where you think that's heading, basically. Obviously, we know this almost, I remember you've called it weaponizing gamma from like the retail army, and how they kind of just coordinate and decide which stock they're going to buy next or buy calls on next and put all their premium into it, and it just works, right? So what do you think about this kind of meme craze, and do you see it just carrying on the way it is? Do you see it evolving? Has it changed in the last 6 months? What do you see?
Yeah, it's changed in the last 6 months. And I think the big change is back in January, I heard recently, and I'm a fuzzy memory here, but I think it was a GameStop. The movement in GameStop was like a 5 sigma event, right? Nobody expected that stock to ever go from $5 or $10 up to $350, $400, $500 a share, right? And that caught everybody off guard. And it wasn't just GameStop; it was 100 other stocks that were squeezing at the same time. And I think that caught a lot of models off guard, right? Citadel has a volatility model when they're they're market makers. They have a volatility model. Hedge funds have a volatility model. Brokers have a volatility model to calculate how much margin they need, right? And the SEC just recently released a report last night talking about the catalyst of GameStop, and they said that the clearing agent, which is the DTCC, issued margin calls to Robinhood based on their volatility model. So that caught everyone off guard, and now that people understand what the possibilities are, right? The potential of this weaponized gamma, short squeezes, and the meme mania, right? People's models could adjust, and what they think is possible is different now. So you can see implied volatility now, in my view, will ratchet up much faster. In other words, the price of options leaps much faster, because I know if a squeeze starts in some random stock, I have to respect that order flow, right? I can't just say there's no way the stock is going to go up another 300-400% because look, January proved me wrong. So those models now, the volatility models, I think adjust much faster. They make the price of options jump much faster. And I think that caps the squeeze, right? Because what was once a very cheap call for maybe a week, right, is only a cheap call for like an hour. And so, you go, well, I'm not going to pay 500 implied vol for an option, an at the money option anymore. I can't do that anymore. And that caps the squeeze, right? And I also think that the dealers have such good information now that they can adjust their own hedging flows to not get caught up in that reflexive feedback loop as fast. So I think it's harder to squeeze now.
I guess maybe as well, the rise of this kind of retail dynamic and the fact that they all go on public forums, right, and to discuss what they think about a stock. That's all publicly available information. So you've got some sites that actually publish the sentiment across retail forums for various names in terms of how much they're mentioned, whether people are bullish, whether people are bearish. I think there's one called Swaggy Stocks. There's another one called Memeberg Terminal, like random names, right? But I guess having that information, and if you're a market maker in those type of stocks, that's probably one of your inputs now in terms of understanding how to risk manage those positions, right?
Yeah. And I think that, it's become a murky source of data, in my view, some of these social, media sites, because, everybody knows about Robinhood now, or Wall Street Bets now. And there are bots on there, right? There are all sorts of actors trying to do all sorts of different things. And so I think back in January, when Wall Street Bets was just kind of becoming this household name, it was like a very clean signal. Like, you knew what these guys were doing, you knew who they were, you knew all the parties involved, right? And now I think it's a little bit, it's not quite as clear, but you can watch the sentiment position, play out on your brokerage terminals. Now you can see volatility spike, you can see calls getting bought, and I've heard there's bots out there that will buy calls and post on Wall Street Bets at the same time, right? And doing all these crazy things to try to get people on their position. I mean, there's this famous CNBC video now of Mark Minervy pumping a stock, and his feed goes out, and it's this whole thing. It was like pretty transparent. This guy's in a position and he's on CNBC, he's trying to pump, right? And that's this has now become ubiquitous, right? The idea of pumping my position, and it plays out in real time all day long.
Right. So before we had these pump and dump schemes, right, where it would be investment advisors or whatever trying to get people into some penny stocks, like the Wolf of Wall Street type stuff. Now you've got randoms doing it on YouTube, right, or on Reddit forums, and they can pump it because everyone buys into the story. It's quite interesting. So then what sort of trading opportunities do you think have come about now from, say, like the higher vols, like you're saying, these cool vols are trading really rich, or they can spike very quickly, particularly in the weekly option space, from all this ape speculation or whatever you want to call it. I still don't understand that term, where that originates from, but it just makes me laugh. What do you think? Like, are there any clear trading opportunities that have arisen from this type of flow that you've been able to capitalize on, or that you think make sense?
Yeah, I think one of the more interesting opportunities is, very simple one is being long some of these meme stocks, particularly AMC and GameStop. The volatility is still so rich, and the stocks don't actually the realized volatility of the stock still doesn't seem to match the implied. So you can do some basic call overwriting there, and I think be fairly successful. I do generally like being short options because those implied, volatilities are so expensive and so high and so rich. Short option strategies, ratio plays are very interesting to me, or butterflies. You want to have defined risk, obviously, but being short in general, Vega in those names, or playing decay, I think generally you can be pretty successful doing that. And also trying to identify the stocks that are going to start popping up and percolating, and are going to be a catalyst, or where there's a clear catalyst before people realize it. I'll give an example. Coinbase is going crazy, right? These last few days, the stock's up a ton. Tesla's up a whole bunch these last, several days, and you can start to see the speculation kind of start to bubble, right? And you can position in those stocks ahead of the squeezes. Sometimes you can still identify when the squeezes are going to take place, and kind of get in front of those.
And I guess your models and your data kind of tries to find that or identify that ahead of time, I guess, right?
Yeah, I think finding, playing the names that have already popped where the volatility is very high is much more transparent and easy to do, I think, because it's obvious when something's had a major move, like a SoFi, or even Coinbase today I mentioned before, and Tesla's on quite a run. And again, because of positioning, that there's a lot of volatility in that name. There's a lot that's about to happen, and you could draw some inferences about how people are positioned in the name, what people think, what sentiment is, and make some really successful options trades that, because the implied volatility is so high, they give you a fair amount of error room, right? Like the probability to profit, I guess some of these people like to call it, can be pretty wide, because the implied volatility is so high. There's a lot of people out there that will overpay for options. They'll buy calls at such high levels that the payoff for those positions are nearly impossible, right? And I think you can sort of try to take the other side of that bet. So I can still bet that the stock's going to go up while being short, some very expensive calls.
Mm-hmm. And then in your sort of positioning data, you've obviously got some embedded assumptions, right, as to which way round dealers are versus which way round the clients are. And I guess in the index, my guess would be in the index space, it's structurally put buyers, clients are put buyers and call sellers, but in the single stock space, particularly in the meme single stock space, not the big large cap Apple types, but like the meme stocks, it's completely the other way around. So do you make those different assumptions in your model? And then do you how do you decide if your model is actually accurate or not? Like actually it reflects the true positioning is there a way of confirming that your model's got it the right way around? Like how do you look at that?
Yeah, that's a really good question. So I would say that we have two different models. We have a model that is for the S&P 500, which is the index flow, which does assume that dealers are dealers are buying calls. So the big funds are usually selling those calls. So dealers are long calls and they're short puts. Traders are typically buying puts for downside protection. Now, whether you look at individual stocks where we assume that dealers are both long calls and puts on balance, or that sort of different S&P 500 model, if you overlay volatility, right? If you look at skew and term structure, we've been looking a lot at sticky delta volatility or fixed strike volatility. If you sort of overlay that surface onto where people are positioned, you can very quickly figure out which way people are leaning, right? Now, there's some shades of gray where there's not much of a position that you could tell, but if you look at the implied volatility surface of a name that's getting squeezed, like SoFi again, or AMC or GameStop back in the day, you could see the volatility surface clearly showed a skew towards call buying. And most times you see in the S&P that calls are getting sold, and there will be a bid oftentimes to, I wouldn't call it tail risk, but 5% out of the money. Puts is sort of typically the standard position, and then the shorter dated options, those all get sold, right? That's all just people crushing short dated volatility. But skew was so high in the S&P for the last several weeks, and so you could just verify your position and your thesis is correct off of
that makes a lot of sense. Yeah, and for those who don't know that term skew, so we're talking about the difference in implied volatility between say downside puts or upside calls. And the idea is that if that implied volatility was completely the same in those options, those out of the money options on both sides of the distribution, that would be no skew. But typically in equity markets, particularly in equity indices, we tend to see a supply demand imbalance that shifts that implied vol premium to the put side, and it makes the calls relatively cheaper because there's lots of sellers of them, and that skew kind of gives you a clue on which way round the positioning is that the dealers get left with, basically, right? So that makes sense. Overlaying the skew on top, using that as your model to decide positioning, and then I guess monitoring that change in skew as well as price is moving is even more confirmation, I guess, right?
Yeah, 100%, because I think at the end of the day, so we could tell because it's public information what the open interest is. And so we could figure out where the big strikes lie, where's the big call, where a big call is positioned, where a big put's positioned. And then if you overlay the implied volatility, on top of that distribution, right, the distribution of gamma, you can again start to see, okay, for some reason, dealers are, have really ramped up the price of, out of the money calls, right? They must be getting full. Their inventory must be getting full. And so that's telling me that people are buying those calls, right? Because dealers are going to adjust prices like supply and demand, just like anything else. No one can buy cars. There's no cars available now. Car prices are going through the roof. And I think options are the same thing. It's not necessarily the size of the position there. It's how the dealers are, how much inventory the dealers are.
What gives you, do you have any metric or anything that you look at to really increase your conviction about whether something is going to pin, right? So when you look at your gamma models and your call walls and your gamma flip points and your vol triggers and all that stuff, all that cool stuff that I'm used to looking at, Do you have a way of gauging whether your conviction should be particularly high about a certain asset pinning for an expiry? Like, how do you think about that?
Yeah. So the key metric here, without giving away too much secret sauce, is we look at how much stock volume is taking place. Okay. And we estimate how big the hedging flow is relative to that stock volume. Okay. So the idea is, our market makers, is their hedging flow likely to be a significant amount of the stock's volume? If Citadel's hedging flow is going to be 75% of tomorrow's volume in AMC, then I have a pretty good amount of conviction that the options are going to really control that name, and that the major strikes that I'm looking at, where Gamma is positioned, for example, that strike will stay in play, right? So if all of the Gamma is at $40 in AMC, which it typically is, and the estimated hedging flow is 25% of the stock's volume, then you could say, okay, this gives me a lot of conviction. Okay. And we call that activity factor in our models, and that's available on our site. So, that's the main.
And does that typically tend to be much higher on single stocks than it is on indices? Because I guess index volumes are just massive, right? Or not?
Yeah, well, the S&P is kind of a funny one, right? Because so in spiders, you can tell, and it's a huge position in the SPY and QQQ. SPX is a little trickier because obviously there's futures volume there, right? But the SPX itself is really just a derivative, and obviously there's arbitrage there. So the SPX index itself is based on where the 505 components of the S&P are trading. So there's like some weird, fundamentals in there, but not fundamentals, but there's some weird mechanics as to what is controlling price exactly. But the options complex in the S&P 500 is just massive, right? It's
enormous. Absolutely enormous.
Billions and billions and billions of dollars. It's the key way that most major insurance companies, pension funds, and the like all hedge. And so it is.
I think it's funny. Like, you look back at the last 6 months, almost every significant correction in the market has been on expiry week, right? I mean, just goes to show you in the price action that options seem to matter in the S&P, right?
Yeah. This is so funny because, one of the important sort of moments in my trading life was August of 2015. And I don't know if you remember that, but end of August, there was a massive crash on the market. It went limit down. The exchanges closed. It was a mess, right? And that was an important moment for me that showed, what options positioning does. But I had just been doing some research on this, over the weekend, actually. And I just realized that August 21st, which was the day before the huge crash, was an expiration day. And so I was looking at the options flow on that day, and people came in, they were buying, tens of thousands, hundreds of thousands puts up into the close that day, which is an options expiration day. And then on Monday, we go limit down. And then like the low in the market is essentially the September expiration. So after the crash in August, end of August, September was just a really tough month, really whippy volatility. The market couldn't break out. It was just an ugly, choppy month. September expiration takes place, all those puts expire, and the market goes back to August highs.
I remember it.
So even all the way back then, it was.
I remember it was the China deval story that triggered that, if I remember rightly.
Yeah, and the China deval story, I thought it was going to matter again. I'd, night sweats. I'd wake up saying, "No, China's coming to get us again." And, so far, no one really cares, right? We're back at all-time highs, just despite Evergrande and all that. But I have a question for you around this positioning, and because I know we have just a few minutes left here. But the Bitcoin ETF just launched, right? And I guess this is a futures-based ETF, which is not quite the same as if it actually bought, the commodity itself, the commodity Bitcoin. So how do you see that playing out? What's your positioning view? Or the impact of that?
It's funny because I was going to ask you about Bitcoin, but I was going to say, do you think this whole positioning analysis in options would work on Bitcoin? Or do you think the options market needs to be more established and have more predictable flows? Because like we say, at the moment, how we talked about skew giving you an idea of where positioning was in the dealer community, right?
Yeah.
Well, I've been trading crypto vol for like a year and a half now, and skews all over the place. Like 1 week skew will be for calls, another week it'll be for puts, and then a week later it'll be for calls again. And it's so volatile. Like the volatility of the skew itself is all over the shop with spot.
Yeah.
It doesn't always correlate with spot. Sometimes it does the opposite of what spot's doing. But because there's no kind of consistency, I mean, the longer dated stuff is consistent generally. The cool skew is normally the one that has the premium for anything 6 months and longer. That's pretty consistent, right? But anything in the front end, which is kind of where all the gamma is, right, as we know, that is moving around so much that you're really struggling to get a handle on whether dealers are long or short an area, basically. So you've got to kind of get quite granular with it and watch exactly what's happening on a week by week basis, see how the implieds are moving, see how the skew's shifting, and see where the strikes that are active are to get a sense for where the clients have bought or sold them, basically, right? Now, I do think the more adoption from institutions that we get, and we've had a decent amount already, the more we get of that, we will get more and more consistent overwriting flow, because that is clearly the biggest no-brainer for an institution who's long any kind of Bitcoin or Ethereum to then sell 10% out the money calls at a massively fat premium every month to yield enhance that position is an absolute no-brainer for an institution.
Yeah.
Right? So there you will get a natural supply of upside, which will probably depress that front end call skew. But then whether people are going to be willing to pay up for the downside on 100 vol or whatever it is consistently remains to be seen. So, I don't know. I mean, in terms of to answer your question, in terms of the ETF and the impact that's going to have, early to call, obviously the market front run the news massively and got very bulled up, and there's a lot of speculative buying into the news. That's kind of done now, and the market hasn't done a whole lot since Friday when that news was pretty much nailed on.
63,500 is where we're at right now.
Yeah, so we're kind of squeezing a little bit higher, but we've kind of run out a bit of momentum, right? All the momentum was last week. So, I mean, it looks like we're going to tap the all-time highs and then decide whether we want to break that and go to the moon, or whether we're going to have some meaningful correction, right? So it remains to be seen. Tough one to call, but I don't think this ETF that's been approved is a game changer, really, because it's a futures-based ETF. So what you've got is the whole point of being in Bitcoin to some extent is to be able to self-custody it and have freedom from the system, right? And, anyone who really is a hardcore Bitcoiner or is investing in it for those sort of reasons isn't going to be going into an ETF that is also going to have all these embedded costs, like the futures roll cost that trades at a premium to the spot. Every single month, you're going to be rolling that. So that's going to come to at least 10% a year extra cost of just holding that thing. So I don't think it's going to get loads of traction. And there has been one available in Canada, hasn't got a ton of traction. So it's not the one that's really going to be a game changer for Bitcoin. If anything, it's a stepping stone towards bigger things. Like if there's a spot ETF that gets approved, if Grayscale gets to convert their thing to an ETF, if more spot ETFs get approved and the adoption increases, it opens up the universe of investors that can participate. It's a good thing overall for adoption, but this specific ETF, I don't suspect is going to get a ton of inflows that are going to be significant enough to matter, but it just might be the psychological signaling that the SEC has become more crypto friendly and that type of thing that's going to be more supportive, I would say. Yeah.
Yeah, I think the regulatory aspect of it is certainly bullish. I found when I was looking at the options open interest position that the options position was really just not that big. And the other issue that I had with it is that it's bifurcated, right? You have Deribit, you have the futures exchange here in the US. There's a few other that they're kind of all over the place. If you're in the US, you can't get access to most of these exchanges. I mean, I know a hedge fund could figure out where to domicile to play all these things, but it's all over the place, right? And I have to imagine that. Yeah,
it's very fragmented. I agree, but 85 to 90% of the options volume does trade on Deribit. So to get a real feel of where the options are, Deribit's the place to be. Yeah,
right. And trying to measure that underlying liquidity too, I think would be a challenge. Because there's so many people that hold for real life. I mean, their coins are in cold storage or whatever, and the mining issues and all these other things. So trying to figure out how one might react to a squeeze is also kind of an interesting aspect of that.
Yeah, like I say, I think options positioning will start to matter more and more. But I think the market needs to mature a bit more. And you know, if LedgerX that's been taken over by FTX, if they can really grow their volumes and improve their liquidity and get the US options players into the space in size, then maybe we can start to see some more sensible and impactful kind of flows in the options market that can help predict things basically. But at the moment, I'm not sure how much we can gauge from it, to be honest. But I think we better wrap it up now. It's been great to have you on, as always. Good chatting to you.
Thanks so much. I appreciate it.
No, thanks for coming on. And you know, why don't you quickly tell everyone where they can find out about Spotgamma and check out what you do.
Definitely. I'm at Spotgamma on Twitter, and you can see me at http://www.spotgamma.com.
Brilliant. All right, nice one, mate. And I'll chat to you soon. Take care.
All right, buddy. Take it easy. Bye.
Bye. Thanks for joining us today. I hope you enjoyed the episode. To learn more about Options Insight and our trading community, please visit us at www.options-insight.com. Or you can subscribe to our YouTube channel and also follow us on Twitter at options_insight. Until next time, thanks.